In this video, you will learn how to properly implement price action into 3 simple and effective scalping strategies, and you will stop positioning yourself on the wrong side of the market. If that sounds good, take a seat and enjoy the video. The failed new high of the day, or failed new low of the day, is the first scalping strategy that implies using price action and market structure, which we already talked about many times on my channel. The main point of this trading strategy is to catch quick volatile moves when price fails to sustain a break above the previous day's high or below the previous day's low. So the main idea is to look for the price attempts on making new highs or new lows compared to the previous day. When these attempts fail, it often indicates a potential reversal, giving us traders a scalping opportunity. As you probably know, previous day highs and previous day lows are important levels. These levels are being analyzed and seen by many smart traders. These levels are often seen as potential support and resistance levels. When the price moves towards these support and resistance levels, the market is testing the equilibrium of supply and demand. When price breaks up above the previous day's high, it indicates that there is more demand on the market rather than supply. And if this break quickly fails, it shows that supply is still strong at these levels. The opposite is true for breaks below the previous day's low. This failure of breakouts often traps traders who entered on the break. While traders close their positions, it adds even more liquidity to the reversal move. This is how we can trade this type of setup. First, we identify the previous day high and previous day low. These are our key levels. Then we need to closely watch price action as it moves towards these levels. Wait for the breakout and failure to sustain the newly created trend. If price breaks the level but quickly reverses back again, this can be our potential entry setup. It's best to look for confirmation to increase the quality of the setup. This could be in the form of a reversal candlestick pattern, a shift in momentum, or increased volume on the reversal. Once we have confirmation, we enter in the direction of the failure. On a failed high, we sell short, and on a failed low, we buy long. You will see this setup work many times. It works great because the idea of this strategy is to align ourselves with the smart money like banks, institutions, and traders that have enough liquidity to move the markets. Because keep in mind that us, simple traders from our home, we can't really move the market. It's the big players that do that, and our goal is to simply just to follow their footsteps. This strategy is also great for beginner traders because it's a step-by-step mechanical strategy. There is less room for subjectivity, which makes it easier to follow. In this example, we mark the previous day's lows and previous day's high. As the trading session begins, we see the price approaching the previous day low levels. At this moment, we pay close attention to each and every candle. The market is pushed down by a bearish impulse, with much more aggressive bearish candles than bullish ones. Moving towards the break of the previous day's lows, right after the break, the price action shows a small pullback to the upside, followed by another push to the downside towards the lows. Pay close attention to the market structure, because we can incorporate these concepts into the strategy. So we can see the new lows failed to break the last lows, forming higher lows. At the same time, the price pushes to the upside, breaking the last swing highs. This is a move that we usually call change of character, or market structure shift. It basically indicates that the market is about to reverse the trend. This is where we place our buy position, and taking profits towards the previous day highs. A very important aspect of this scalping strategy is to properly understand the concept of liquidity. Previous day highs and lows are often areas with a large number of stop losses and limit orders. Market makers and institutions could push the price into these levels to hunt these orders to take out their liquidity. If they form the failed break, we're looking to trade the move. So with this setup, you're essentially trying to align yourself with the smart money. More advanced traders can also apply more complex knowledge. For example, you could look at the overall market structure. Look if the market is in a larger uptrend or larger downtrend. Failed breaks that align with the larger trend should have a higher probability to respect the strategy. We could also consider the time of day. Failed breaks that happen during the most important market opens like London session or the New York session might be more impactful because of the increased volume of institutional traders being active at those times. The first major pullback after a market structure shift, this is another scalping setup that works great. It also combines price action with smart money concepts. This strategy aims to catch quick moves right after a change in market structure. A market structure shift refers to a clear change in the macro trend and direction of the market. This usually happens when price breaks a key level, like a previous high or previous low. When we see this structure shift, we know smart money traders are likely changing their view on the market, and after a shift, we often see a pullback. This is when price pulls back towards the level it broke. Smart money usually are using these pullbacks to add to their positions before the next large move. When price breaks a point of interest or key level, it indicates that demand for an upward break or supply for a downward break has overtaken the opposite side of traders at those price levels. But markets rarely move in straight lines. So after the break, some traders will look to take profits. This causes a temporary shift in the supply and demand equilibrium. This action forms the pullback. But if the structure shift is real and is not a false break, the supply and demand equilibrium that caused the break is still met. So when the price pulls back to the broken level, we often see a market reaction as the dominant side of traders, being buyers in an upward break and sellers in a downward break, enter the market again. So this is how we can trade this setup. First, we need to look for a clear break of a previous high or low. This is our first indication that smart money might be looking to move in the other direction soon. After the break, don't try to force the trade, but instead try to wait patiently for price to come back to the broken level. This is where we are going to place the entry and look for the price to move towards the broken level. Watch for rejection signs near those levels. This can be a large volume candle showing interest in moving the market towards that newly created trend. Basically a shift in momentum. If the setup plan confirms, enter in the direction of the break. The stop loss be placed above the broken level. And because this is a scalping strategy, we look to take profits as quick as possible on a decent enough risk to reward ratio. Here we got an example similar to the previous one. Initially, the market followed a downtrend, but has been able to break the swing highs to basically print a market structure shift. On the breakout, we have a small zone from where we can see that the price retests and pushes to the upside. This push eventually forming a macro uptrend that we can clearly see. Now lately on the recent price action, the market eventually broke down below the swing lows, forming another market structure shift, but this time a shift from an uptrend back into a downtrend. And after the break, the price quickly hits up the broken levels. This was caused by a pullback to the upside, and as we said before, the pullback to the upside happens because the sellers are taking profit on their positions. But at the same time, smart money accumulates their positions, increasing the size of their orders. And this is what causes the upcoming downside movement. Similar to the last example, we take a sell short on the retest. Jumping into a final backtest, here we can see on the left of the chart the swing low of the market structure, and if we draw the line, we clearly observe how the market has recently broken down those lows, basically forming new swing lows. But the main idea is that the market has shown a reversal from breaking the swing lows in an uptrend. That is called a market structure shift, and a shift that is broken down is indicative of a reversal into a downtrend. On downtrends, we look for sell-short setups. And using this scalping strategy, we draw the broken zone, and we consider the pullback into the zone, the opportunity for us to follow the smart money into taking the market towards new lows. Now we can see that the market here has hit the zone. However, just with a wick, we need more convincing price action. This is what we want to see. Now I will be placing the sell short. For the stop loss, it should not be too close because we see the recent candles are more advantageous towards the bullish side. So we don't want to get stopped out just for the market to move in to take profit after the position has been closed. But we don't want the stop loss too far away. I'd say about here is fine, near this wick. And for the take profit, we are looking towards new lows, for maybe around a 1 to 3 risk to reward ratio. And let's play the price. Almost got stopped out. It's very important to understand liquidity to master trade positioning. This also could have been a win trade if I decided to keep the same risk to reward ratio. But having a smaller stop loss but with a smaller take profit as well, keep in mind the liquidity, it's very important. Another great scalping strategy is using the fair value gap breakout. The fair value gap is formed when a 3 or more candle sequence, where we usually see a large candle that has smaller candles in between. Those smaller candles' upper wicks and lower wick do not overlap each other, this leaving a gap on the chart, also named being an imbalance. Here is how we can plan scalping setups with the fair value gap during a trending market, when the price breaks the key level to continue the trend. If the breakout was made from large volume size candles, most of the times the market will leave an imbalance. The market will eventually pull back or retrace into the gap. That is also when we can enter a position that respects the main trend, especially if we trade for trend continuation. Now, market structure should also be implemented. The reason is because we can find multiple fair value gaps, so we want to make sure we identify the proper one that we'll respect. So in this example, we will do a more complex price action analysis. At the first view of this market, we see that it went directly to the downside for a while, a pretty clear downtrend on the short term. As we know, the downtrend is characterized by a repeated form of swing lower lows and swing lower highs. Just like we can see here, a formation of new lows, followed by a pullback to the upside, just to break the lows shortly after forming new lower lows, and pull back to the upside again, forming lower highs, then break of lows. And basically this downtrend formation keeps printing for a while. To make sure we clearly understand the market structure, I will mark all the swing formations. So here we got a lower high, then a lower low, lower high, lower low, lower high, lower low, lower high, and lower low. Now pay attention here, because after some time, the market finally broke out above the last lower highs. We can see it via this wick, this actually forming a swing higher high, which we can observe that shortly after that formation, we got a pullback to the downside. But the pullback did not manage to break the last lows, and it actually ended above the last lows. So this is a clear higher low formation. So now you tell me, a swing higher high formation, combined with a swing higher low, does it form an uptrend? And clearly the answer is yes, and we can see what happened right after printing that bullish uptrend formation. The market just pushed upwards significantly. So we make sure to mark the structural shift levels. Here he got the market structure shift that caused the formation of the uptrend. Right after, we got the bullish break of structure that validates the uptrend. And the last one we can see is another bullish break of structure. So now that we know that the market is following an uptrend, that is very important to understand. Because in uptrends, we look for bullish fair value gaps, and not for bearish fair value gaps. Some traders know how to identify the gaps very well, but because of poor understanding of the market structure, they trade opposite side gaps, which is quite unfortunate. So the key question here is, what has caused this recent upwards push? And if we look closely to this sequence of 3 candles, we can see the formation of a bullish fair value gap, taken from the first candle's upper wick, with the third's candle lower wick, and this is the price gap where I will place a buy long order. Don't forget, we also don't want too tight of a stop loss, but at the same time, not too far away, and the same logic applies for the take profit. So right here, the position has been opened, and has instantly rejected to the upside right from hitting the fair value gap. Shortly after, moving into the take profit. The fair value gap setups are one of my favorites. It's one of the only trading models that delivers such beautiful setups. Also, let's just see the continuation of the price, because this market looks very bullish right now. And it has moved into new highs, basically breaking above the last high. So we could have even taken more out of this setup, but it's fine. It's important to not be way too greedy. We are jumping into another backtest to make sure everyone understands it well. So taking it step by step. The first step is analyzing the macro market structure. Now in this example, the market structure is actually more complicated because look how weird the price has moved. Kind of sideways. But also looks like it moved in a trend also. So here it's more complicated. But if we draw the structure, here we got an upwards push, followed by a downside movement, which creates a lower low. That is then followed by a pullback to the upside. Then it comes a push to the downside, but pay attention to this move, because it ended higher than the last lows. So let's actually mark all the structural levels since the start, only the important ones. Here we got the market structure shift into downtrend, but then it failed to hold the downtrend for a longer time period, because right here we got another shift into an uptrend, basically caused by breaking the last swing highs just for the market to shortly continue an uptrend price action forming new highs. So we basically got another bullish break of structure. See how simple analysis can be. When you get confused, you can just take it step by step. So now that we know that this market is following an uptrend, the expectations would be for the price to form a pullback, which already did, and then a push towards the upside to break the last highs, and finally forming new highs respected with breaks of structure. So now let's move into the most recent price action, basically moving into the micro analysis. So we got constant swing higher lows, with constant swing higher highs, essentially the basic formation of an uptrend. So for the setup, we look at the most recent price movements. Here we got a break of the highs. It's where we need to closely look at setups, and there is the sequence of candles if you pay attention. So again, applying the fair value gap theory, taking the first wick's upper wick with the third's wick lower wick, and that is the empty gap zone that needs to get filled. So on bullish fair value gaps, we look for buy-long setups, kind of similar to the previous setup. Stop loss fits well below the last lows. And for the profit, we can try to these highs, but the risk-reward is not worth it. We can also try more towards the swing highs, but then the risk-reward can get too large. Around these levels, it's fine. Here the position got triggered, and similar to the last one, the price jumped up near instantly after hitting the zone. And soon after, we got the take profit hit. And let's see here too if the price can get above the highs. Just to observe, and it looks like it will break the highs. So this too could have been a better setup. I usually don't like to risk too much, so I wouldn't want to aim for more. This is already enough. The Fibonacci retracement combined with market structure. This is another great scalping strategy to trade pullbacks. This strategy also requires a market to be trending, either following an uptrend, either following a downtrend. It must be trending, else this strategy will not work well. So if we see a market that is following an uptrend market structure with higher highs and higher lows, having the breaks of structure to the upside, our plan is to take the Fibonacci retracement from the most recent swing low to the most recent swing high that's situated above the break of structure, and closely pay attention to the 0.5 to 0.618 zone. This zone is what traders call being the golden pocket or the golden Fibonacci zone. It has got this name because of effective strategies built around these levels. The market will often move into the golden zone. By a move named as a retracement, it is essentially the same as a pullback. And we will often see how the market will bounce from these levels to move towards the main trend. And on downtrends, the same theory is applied, just to the other side. Seeing a downtrend market structure that is formed by lower highs and lower lows. With the breaks of structure to the downside, we take the fib retracement from the previous swing high to the previous swing low that is usually situated below the break of structure, and we look for the market to move into the golden zone, moment where we can look for a reactionary movement as a sell short position. So let's see how a backtest using this strategy looks like. First of starting with the market analysis, which is clearly a simple and clear uptrend, an uptrend with their own bullish breaks of structure. They are formed simply by constantly breaking swing highs in an uptrend, and we can also see how we got swing higher lows as well. So this is a clear uptrend structure. Now moving into the recent price action. Seeing the formation of a bullish macro trend but the micro trend as well following the same structure, we take the Fibonacci from the recent lows to the recent highs, and we closely look at the golden zone, level where we buy long, stop loss below the fib retracement which coincides being below the last lows, and take profit above the highs, but not too far away since we are scalping. On another example, in this market we see a slight downtrend formation. If we closely analyze the swing levels, we should be able to see swing lower highs constantly, with their respective formed swing lower lows. So moving into the recent price action to plan the setup, we see a constant rise of the market, but this upside movement got broken down. This is what is called shift in market structure, but because it's on internal or microstructure, we usually call it an internal shift. So applying the fair value gap with the market structure strategy, we take the Fibonacci from the recent swing high to the recent swing low, and the price is actually right at the golden zone currently. So in this case, following a bearish trend, we sell short the market right away, with stop loss above the highs and the take profit below the lows, because on downtrends it's what we expect. We expect formations of lower lows. And this setup took just a couple minutes from start to finish. These are one of the most effective scalping strategies to learn that are not overly complicated. As you've seen, it's very important to understand to read the market properly, because the rest of the plan is just mechanically, by just respecting a step-by-step approach. I can help with extra materials that you have on the description. I try as much as possible to make simplified trading while also providing high-quality knowledge. If you like it, like, share, and subscribe. Thank you for watching and have a great trading session.